Hello, I'm Brian Harris of Ventura, California. I'm the owner of Harris Mortgage. Today, I'd like to talk to you about mortgage insurance, how to get rid of it, why now is a great time to make that request, and why your window just might be closing. Now, before we get into how to remove your mortgage insurance, just want to do a quick 101 on what mortgage insurance is. So it's tied to, in this video, conventional loans, and those where you put less than 20% down. So if you put less than 20% down, you're required to get mortgage insurance in most cases. It's paid typically monthly, can be paid all up front, but as it relates to this video, it's paid monthly, and it's required when you have less than 20% down. One quick disclaimer before we go further. I reached out to a mortgage insurance company, and I used the information that they provided to develop this video. However, there's several mortgage insurance companies in existence. Yours might be different. However, I do feel it'll be similar, the rules will be similar, and the video will still be helpful. So there are two ways to remove mortgage insurance. One route is based on the original value of the property, and the second route is based on the current value of the property. So first, we'll go over how to remove based on the original value. What is the original value, you might ask? So on a purchase transaction, it's going to be the purchase price or the appraised value, whichever is lower. So if you had an appraisal come in low, it's going to be the lower appraised value number. Otherwise, it's going to be a purchase price. And on the refinance, it's going to be your appraised value based on that refinance. This video is going to inform you if possibly you're eligible to have your mortgage insurance removed. But if you are, even if you just think you might be, what do you do? So what you're going to do is you're going to call your servicer. Now, your servicer is a fancy way for saying the company that sends you a mortgage statement every month. So you're going to find your latest mortgage statement. There's going to be a phone number on that statement to call, easy to find, and you're going to call that number and you're going to tell them you would like to have your mortgage insurance removed. But that is who you call. Okay, so canceling based on original value. For some reason, mortgage insurance companies will require that you call when your loans reach 80% of the purchase price or the original value and say, I'd like to have my mortgage insurance removed. And then they'll actually automatically remove it when it gets to 78%. So first thing, if your loan is 80% of the original value, you could call the servicer and request your mortgage insurance is removed. It should be removed if there's no subordinate lien, so you don't have a HELOC behind it. You're in good standing with payment history, and the lender does not suspect that you've had a decline in value. So as using numbers as an example, for $500,000 purchase, when your loan gets to $400,000, 80% of original value, you can call servicer, request your mortgage insurance be removed. So in the last example, I slipped in at the end that requirement that the lender determined that the property has not declined. So that's using 80% of the original value. Now, the next way to have your mortgage removed is it's lender required. So you actually don't have to call about this. You could call if you see your loans at 78% of the original value and it's still, and mortgage insurance is still there, you're like, definitely call, but it should come off automatically. In this case, there is not that requirement that the property value has not declined. So the property value can decline. Loan amount is 78% of the original value. Lender will remove your mortgage insurance. And the only reason they would not, I say remove, sometimes they'll say cancel. They won't cancel your mortgage insurance if you're behind on your payments. So the borrower needs to be current on your payments. Mortgage insurance will fall off. 78% of the original value. Instead of removing based on original value, here's how you'd remove mortgage insurance based on current value. So the rules are not black and white. What I've listed here is what's typically required by Fannie Mae, Freddie Mac. And of course this request needs to come from you to the servicer. If you have a bunch of equity in your house, you have mortgage insurance, they're not going to call you and say, hey, you should get rid of your mortgage insurance. So you need to make that request. The loan needs to be at least 2 years old, so seasoned 2 years. If it's less than 2 years, you would need to have mortgage insurance removed based on the original value. You can always call the servicer and ask, but typically you need to have 2 years seasoned. You need to have a positive payment history. Now, if you've had the loan for less than 5 years, so like between that 2 and 5 years, you're going to have to show 25% equity based on the current value. And if you had the house for over 5 years, or you were in that loan for over 5 years, you can show 20% equity and have your mortgage insurance removed. Now, when you remove based on current value, often the lender will require that you get an appraisal done, which could be $500. So you kind of want to be sure the value is there, because they will charge you for that appraisal. Sometimes you get lucky, they have what's called a desktop appraisal, and that's typically some piece of software they have that's free. But in many cases, when you're removing mortgage insurance like this, they need it verified by an appraiser. Talk about that a little more later. So here's an example of what that might look like. So again, you bought the house for $500,000 with 5% down. The loan starts at $475,000. Again, you need to get that loan down to $400,000 to have 20% equity based on original value. So let's say after 2 years, you paid that loan down to $460,000. Still, you don't have 20% equity based on the $500,000 purchase price, but your price, you're looking at neighbors' sales, you think the value is $625,000. So at $625,000, you have over 25% equity. You have 27% equity. You have 73% loan to value. So you'd be eligible to have your mortgage insurance removed. So because it's seasoned over 2 years, you have that over 25% equity. You're going to call your servicer and you're going to request that mortgage insurance be removed. So this is a perfect example of someone in this situation. A lot of people are in this situation. We have had a lot of appreciation in the last 2 years, and a lot of people are sitting with equity paying mortgage insurance. So this is what I made this video for, people in this exact situation. Check it out. Look at your loan balance, pull up Redfin, punch in your address, Zillow, whatever you want. Those aren't completely accurate. If you have a relationship with the realtor who sold you the house, you probably reach out to them. They could do a better job of giving you a more accurate estimate. But get an estimate of the value. Look at your loan balance, divide the loan by that value. If it's under 75, if you've owned the house for less than 5 years, you're in business. If it's under 80, if you've owned it for over 5 years, you're in business. So this is why I made this video. This is what you need to check out. Get those 2 pieces of information, check it out. If you watch this video, you call, you get your mortgage insurance removed, please send me a note, send me a comment, let me know. That'd be sweet. I'd be real happy about that. That'd be awesome. So I want to talk real quick about why I wrote ASAP and why I said your window might be closing. So here's why. So if we look at mortgage rates last year, 2022, they more than doubled. So rates started the year just about 3.125 on a scenario I checked, And at the end of the year, that same scenario was 6.75%. Rates have come down a little bit in January of 23, but that is more than a double. Really painful. But let me tell you why this makes me think if you can remove your mortgage insurance, you should move on it ASAP. So I'm recording this at the end of January. In January, there was existing home sales information that came out. In that report, there was this chart, and it shows the median price of existing home sales year over year. So when you look at this chart, it shows you that the existing home sales price increase is slowing, but year over year from December 22 to December 21, this chart here from NAR shows prices have increased. So we've had that huge run up in rates, and we're starting to see a softening in prices, but year over year they're up. So this would show that their median price is up 2.3% year over year. Shocking. So if we look at those rates and how it could change your payment, I just put an example. So we're talking about a $500,000 purchase. Let's say you put 20% down. Beginning of the year, your payment, and I'm including the taxes and insurance, so those will stay pretty steady, and it mutes the change in the mortgage payment. So I'm being like totally fair, conservative here. So beginning of the year, 500,000, 20% down, your payment would be $23.34. So that includes your principal, interest, taxes, and insurance. Okay, so whole thing, all that. If you buy that same $500,000 house at the end of the year, 6.75, your payment's $32.15. And you know that includes your taxes and your insurance being exactly the same. So that is a 38% increase in monthly payment, which is just wild. It'd be more if I only looked at the increase of the mortgage, it'd be even bigger. But 38% is how much it costs more at the end of the year versus the beginning of the year. Same house, same price. Quite amazing. So in the third column here, we're making the end of the year rates with the beginning of the year payment, and what would that price be? So you can see we're trying to back into something that's close to that $23.50. I mean, we're not putting just 20% down, we're putting a whole 100 down. We're putting the same amount down, getting the same payment. What kind of price can we afford? So you can see as the price drops, the property tax drops too. But it would be a $385,000 house. So what you can afford for $500,000 at the beginning of the year, that payment gets you $385,000 house at the end of the year. So that would be a decline of 23%. So there's a lot of factors that go into price of homes, supply being a big piece. But if you look strictly, just zero in on rates and what that should do to the prices, it should translate to a substantial drop in prices. And the previous slide I just showed you, it shows that hasn't happened yet. So it hasn't happened yet. Doesn't mean it's not going to happen, just it hasn't happened yet. And so relating this to removing your mortgage insurance, couple things. When you remove mortgage insurance based on the current value, again, you're probably going to need an appraisal. Now, an appraisal is going to benefit us because it's based on closed sales. So it's based on transactions that close. So I'm seeing this, I don't know if you've seen this, but if you see houses staying on the market longer, price reductions, that won't impact your appraised value because it hasn't closed yet. So as time passes and some of these prices of properties that have had price reduction, they close, then it's a comp on your appraisal. So that's why I put in ASAP, because it seems like prices should decline, they haven't. So it's nice to take advantage of it by getting rid of your mortgage insurance. We've had a lot of appreciation. If you've had your house over 2 years, if you've been in that loan over 2 years, just call your servicers, ask them to get your mortgage insurance removed. Say, I think I could do it. What do you think? So they'll tell you the exact procedure. All servicers might have a bit of a different procedure. Generally, this will apply. So please, again, if you enjoyed this, like, subscribe, and if you watch this successfully, get rid of your mortgage insurance, I'd love to hear back from you about that. So good luck. If you can call me or email me for help. I can hold your hand for the phone call. Be great to participate and get rid of this mortgage insurance for you. I know it's a tough time, and this could help. This could be a help. So that's all for now. Have a great day. Till next time. Bye. Window just might be closing. Closing. Your window just might be closing. That's better.